What is up, team? All right, today I'm going to be talking about, I forget what number book I'm on. Talking about a book. I'm going to share my screen with you so you can see here. So, book number 8 it is. There we go. It is What Would the Rockefellers Do? I know I told you I was going to be talking about alter ego, the alter ego effect, but this one came along and it was short and it kind of tied into the previous book I talked about, which was Killing Sacred Cows. So I wanted to kind of blend them together a little bit because they just worked out well. So, what would the Rockefellers do? This one is written again by Garrett B. Gunderson. He wrote the last one as well. It's basically talking about how to set up a financial legacy for yourself and while you can utilize it while you're still alive, but then also set something up for the future as well, for generations to come after you. So, a bunch of different things they talked about in this one, but it starts off by mentioning two families that were super, super wealthy in the late 1800s, early 1900s. One was Cornelius Vanderbilt, who, as I say there, amassed just over $200 billion in wealth in today's dollars. Um, but their families somehow squandered all of that wealth after just a couple generations. Whereas John D. Rockefeller also had about 200 to 300 billion dollars. It's a lot of money. Well, in today's dollar, 200 to 300 billion dollars. But that money is actually still serving his family today. So 6 generations later, the family trust is still worth billions and billions of dollars. Chapter 2, can I really have my own family bank? Yes. So first of all, before we get into any of this stuff, first of all, I want to say I am not, again, not a financial advisor. I just started looking into this sort of stuff because I thought it was really interesting. And there's a lot of people that the traditional way of doing things isn't working for a lot of people. Sometimes people follow the majority, but the majority of people are stuck and not wealthy. So this is something that the minority are doing. So maybe there's something to it, right? The minority of people are the ones that are a little bit more wealthy. I think it's like 90% of the world's income is owned by 10% of the population. So let's follow the minority, not the majority, when it comes to this sort of stuff. That's my thinking, at least. So yes, you can have your own family bank. In general, the principle is that you pay into a policy and then you can take money out against that policy and basically just give a loan to yourself. So, like I said, you need to go talk to probably some financial experts about all this stuff, and someone who knows this stuff inside and out. I don't. This is just the gist from the book. If you want to talk to someone who is a professional at all this stuff, let me know. I've been talking to someone for a couple months now, and they've helped me set this stuff up, which is awesome. So yeah, let me know below, comment below, or send me a direct email or message me, and I can get you that contact info. Quite often, you will hear people say that this type of plan is not good, right? Because you could be saving the money from that you're going to be paying into the policy. You could be saving that and investing that, and you'll come out ahead later on. Um, that's what some of them will say. In this book, it says that um, these two people that he mentions here, Dave Ramsey and Susie Orman, are really, really good at helping people get out of true debt. So when they're in a really dire financial situation, they're really good at helping them get out. But as far as wealth accumulation and creating a lasting legacy that you can pass down to your next generation, he says that there is a better way. In chapter 4 here, so he's talking about what cash flow insurance really means. So quite often, people think that maybe after they've accumulated a certain amount of wealth, they're self-insured, but that's not necessarily the case, right? So I talked about that in the last book a little bit, but what this policy is going to do is safeguard your wealth, so it's not able to be touched in a lawsuit. You got really good tax benefits in it. It keeps accumulating interest. If you take money out, it keeps accumulating that interest on the dollar amount that you've put into it. Um, Helps grow your money and increase your cash flow so you can utilize the money in that policy, like I said, and you can utilize it right now. You do have to pay it back over time, but it's basically you're paying it back to yourself instead of to a bank. and it can help your money both today and tomorrow. Basically, in those two scenarios that I just said there, you can use it today, right? To maybe if there's a big opportunity somewhere, you can use that money to invest in that, and then it also is accumulating wealth for future generations and for your retirement. Finding money to fund your bank account. He talks about four main types of expenses. Sorry. Destructive expenses are things that don't do you any good whatsoever. So that would be like gambling, um, purchasing drugs, stuff like that. They don't provide your life much value at all. You want to manage consumptive and protective expenses. So consumptive expenses are things that you do normally every day. Maybe you go shopping, you're saving for a vacation, buying a car, that sort of stuff. Protective expenses are things that you are paying into, like um, car insurance, home insurance, life insurance, that sort of stuff. You want to manage those types of expenses and then increase the productive expenses. So productive expenses, I kind of talked about a little bit I believe in the book before, about how if you buy something that is going to give you more value later on, that is an expense that is productive, right? Because you are paying that upfront cost to get more benefit later. Short term cost for long term gain. Chapter 6, it's a whole life insurance policy. That's the vehicle that we're using here in order to get to our retirement and pass it on to generations. Um, he's talking about why it beats the alternative. So there's a lot of benefits to it. Maybe it's not for everybody. Obviously, it's not, because a lot of people are not doing this. A lot of people are maybe just following what other people are doing, but this type of setup does have a lot of really, really good benefits. First of all, the cash flow policy is not affected by the stock market. So what's been happening recently anyway, stocks have gone way down, right? So if I have had money in a TFSA and all of a sudden, boom, I've lost a couple $1,000s, and that does not feel very good, right? What happens in this policy is that it's basically, if you're locked in at a consistent percentage return plus dividends, so then your money keeps building. Um, it's not doesn't have those ups and down fluctuations as you do in the stock market. He says that this method has survived hundreds of years, even made it through the 2008 recession and the Great Depression, and is still stayed strong. During those times, banks and businesses, a lot of them ended up going out or getting shut down or being hit significantly, whereas these companies have stayed strong, the companies that offer whole life insurance policies in the right way. You can also utilize the money now and in the future, like I talked about before. The death benefit is guaranteed, so that's a big one. So normally when you take out a life insurance policy, it's term life insurance usually. So you're only guaranteed for that set amount of years, and after it's done, you don't necessarily get the money. If you died like the next day or the next week, you don't get that money because you're not insured anymore. What this means is that no matter what time you die throughout your life, your dependents or your significant other, your spouse or whatever, is guaranteed that money no matter what. Also, your premiums never go up. So from the time you lock in your very first payment, that the premiums don't go up throughout the whole life of the policy. Another thing it does is also gives you certainty, right? So those last two things I mentioned, it gives you certainty on these two things, because you know, first of all, that your people you care about are gonna get some money when you die, and your premiums also never go up. It gives you peace of mind too, a little bit, like you know you're insured, so maybe you can be a little bit more productive in your living years. So setting up your family bank and cash insurance the right way, exactly what I've talked about this whole time. Make sure we're leaving it to the professionals. There are certified insurance specialists just for this. And there's a person that I've been talking to as well. Um, again, completely certified. They know what they're doing. They kind of work with you with the situation you're at, how much money you're currently making, what your future goals are, what your strategy wants to be, and stuff like that. So it's been really, really good to work with someone like this. Protection leads to production. So what that's meaning is your life is protected now that you're paying into this policy. Yes, it's a little bit more expensive than term insurance, but it's giving you peace of mind as well as the earnings, right? So the policy is growing the whole time you're paying into it. but it also gives you some peace of mind knowing that you're going to be taking care of those that you love. Chapter 8, cost and benefits. What's in it for you? Like I've said before, there's some tax advantages. It provides protection and privacy. So sometimes if someone were to come after you in a lawsuit, your TFSA or something like that, let's say, or a 401k could maybe become part of that lawsuit. But it's in this vehicle anyway, it can't be touched when it's set up the right way, like I said. Another thing that it does is it earns interest instead of paying interest, which is pretty cool. So when you take out a loan against, or you take out some money against your policy, it doesn't affect the actual number value, dollar value that you have in the policy, which sounds confusing, but um, again, talk to someone and they'll clarify it for you. Um, so yeah, you take out money and it doesn't affect the actual cash value in your policy. So let's say I have $20,000 in my policy. If I want to take out $10,000, I still have this 20,000 that's accumulating interest. Okay, doesn't that 10,000 I can use now. I'll have to pay it back later, or it's good practice to pay it back later. But that $10,000 that I took out doesn't take away from that 20,000. Again, it might seem confusing, but talk to someone and you're gaining interest that whole time in the policy instead of when you normally would take out a $10,000 loan from the bank. You're paying interest back on that $10,000. Let's say it's 10% interest or whatever. You end up paying $11,000 on that $10,000 loan. Whereas if it's the 10% into your life insurance policy, your policy you end up paying it back to yourself, which is pretty crazy. Chapter 9, 10, and 11 basically talk about a lot of this book got kind of repetitive, not gonna lie, but it's all pretty good. So you can turn your death benefit into living benefit, but we talked about that a little bit already. um, you buy your net worth instead of building it, so that's like paying into the insurance policy in order to create your net worth instead of building it and accumulating it in, let's say, a TFSA or 401k or something like that, or any other type of savings account. As you pay into that policy, the death benefit grows. Um, yeah, and the bigger the death benefit, the more money you can take out against your policy. So I believe most policies you can take out up to 90% of the cash value in that policy. So if you've got cash value of $100,000 in that policy, you can take out a loan to yourself of $90,000. You can use it to buy a car, put a down payment on a house, and like I said, that accumulation of interest is not interrupted. But if you were to save up and pay for something in cash, then the interest on the loan is obviously still going up. That is that book. It's, I know it's a little different than the normal financial ways that we've been taught growing up, but I think it's always good to look for other ways to think about it and actually research it and get an informed decision. Talk to a professional. Of course, they've got a vested interest in it, because if they sell you a product, it's going to help them out too. But if you find the right companies that are truly looking to help people, um, and the guy I'm working with has his own life insurance policy in the same company that he suggested I go into. So it's not like I find that very comforting, I guess, is to go where if they trust it enough that they're doing it themselves, um, then it's a lot better, feels more comfortable for it to happen for me as well. So that was quick, not quick. My talk wasn't quick, but that was a shorter book. Read that one really quickly. Next one is one that I'm going to actually talk about this one this time, The Alter Ego Effect. This one was listened to on Audible. I will again put the links below so you guys can check these books out if you're interested. And as always, feel free to leave a comment, ask me any questions. I will try to answer it. If not, I can direct you to the professional that I am currently working with, and we can get you started on that one. Have a good day, everybody.